Unfortunately, since the first of the year, mortgage rates have literally skyrocketed. In the first 4 months of this year, the 30-year fixed rate mortgage is up 0.75%. And as I record this, sits at 7.41%, according to Mortgage News Daily. And so what are we supposed to do, right? This is the year that many of us thought that finally we were going to get relief from these high interest rates, high mortgage rates, high car loan rates. So what's going on, and what should we do, and what's the impact on us? First, I want to start off as a financial advisor for over 20 years. A lot of clients are asking me, what should I do given this reality? So let's first talk about the math. What is the impact of these higher rates? So at 7.4%, if you had a $500,000 house that you wanted to buy, you put down 20%, which would be $100,000. So you have a loan of $400,000. That mortgage payment, according to bankrate.com, would be $3,165 as I record this. But at the first of the year, when rates were 6.7%, that loan would have been about $200 a month cheaper. The monthly payment would have been $2,976. Now, as I said, many of us were hoping interest rates would have gone down this year. It's not happening yet, let me preface that. But if interest rates had dropped to 5%, instead of paying $3,165, your payment would be $2,542, over a $600 a month difference. I mean, that's a lot. For many people, that's a car payment, right? So that's a big impact. It impacts our savings and our plans and what things we can spend our money on. Now, it wasn't that long ago that interest rates were just 3%. And at 3%, that loan would be a little over $2,000, that loan payment, $2,081. So that's a difference of over $1,000 a month. That's a big, big difference. So what are we supposed to do? So the first thing I'd say is, if you own a home, I hope you like your home, because you're likely going to be in it a little bit longer than what you were hoping for, right? And as humans, we're adaptable. So we change based on what's going on. So if we own a home, at least we're in the real estate market. And at least as prices go up, and recently, Case Shiller did their survey of what housing prices have done, and they continue to go up. So you're benefiting from that. But what about the folks that haven't bought a house yet? What can you do? And I think there you have to be flexible. You have to think through, is it worth waiting a little bit longer and seeing if rates do go down? Unfortunately, what I call the last mile of the fight against inflation tends to be a long slug. So the move from almost 10% inflation 18 months ago, 2 years ago, down to the low 4% range that we find ourselves in now, the high 3% a year range, that first move tends to be easier, right? The Fed can increase interest rates, slow down the economy a little bit, and bring inflation down. But that last mile could take some time. We could still be a year to 2 years away. So that's a long time. So if you're looking at the market and thinking, what do I do? You have a couple choices. As I said earlier, for folks that own their house already, at least they're in the market. And if they're going to be in their house for a while, hopefully they can benefit from the appreciation that we've been seeing. So if you're not in the market now, I think staying on the sidelines and waiting and hoping might not be the optimal strategy. None of this is financial advice. I just want to give you some things to think about. Another plan might be, maybe you buy in a different neighborhood, or you buy a smaller house than what you were hoping for. So many of us have heard the term a starter home, and many Americans, we change location along the way. We change homes as we get kids. Maybe we get a bigger home as our kids go in different levels of school. Maybe we change to be closer to our favorite school. So it's not an ideal situation, but few of us can buy that one house and stay in it forever. Interestingly, Warren Buffett, who's one of the world's most renowned investors, and many people would say one of the world's best investors, he's been in his home since the 1950s. So apparently he chose wisely. So not just with his stocks, but also with his primary residence. But the reality is few of us get to do that. So we have to be adaptable. So I don't know, and anybody that pretends to know, I think you're just fooling yourself if you think you know, because interest rates are one of the hardest things for anybody to forecast. And so there's a lot of smart people last year that were saying, oh, we were going to get some rate cuts last year, and that didn't happen. And then they pushed back and said, oh, early 2024, folks thought that we'd be getting some interest rate cuts from the Federal Reserve that would trickle down into mortgage rates. But you know what? That didn't happen either. So you can have your own opinion, and that's great. But I also want you to be realistic and look and say, is there a plan B that we could do? Is there something we can do? And if you're currently in a house and you were hoping to move to a bigger house or to a different school system, is there another way that you could accomplish that goal? Could you rent out your existing house and rent a home in the neighborhood that you want to be in if being in a certain school district is important to you? Could you stay in your home but make some relatively inexpensive home improvements that would make that home work for you for a couple years? Because if you bought your home several years ago or even a decade ago, you either bought with a low interest rate loan or you hopefully refinanced into a low interest rate loan. And as I showed with this example on a $400,000 loan, if you're locked in at 3% versus 7.41%, the current rates, in that example, it's over $1,000 a month difference. So I don't want to see you make sacrifices and put yourself, again, you have to do what's right for you. This isn't financial advice for you. I don't know your situation, but giving up a 3% loan, if it's optional for you, if it's a nice to have versus a need to have, if you're relocating to a different town and you need to sell your house in order to put down down payment on your new house, you don't have many choices, right? One of the things you could do is you could rent out your house to keep that low interest rate in place and rent a house in the new location. And the benefit of that is, sometimes things don't work out in a new job. So you relocate for the job, you give up that 3% mortgage rate, and then you find out, hey, this job wasn't what I thought it was going to be. And maybe you end up moving back home. Boy, much better off to have rented it out during that period of time and still have access to that home and that low interest rate when you get back. So I think the key for this period of time is flexibility and just thinking through what your other alternatives are. And for many of us, for most of us, our home is our largest asset. And your goal here is to make a good decision. Because it can be expensive, right? On a $500,000 home, if you're selling that, a 6% real estate commission that you're going to pay on that, that's $30,000. That's a lot of money. And if you end up buying another home, even though the buyer doesn't pay that commission, typically it's paid in the United States by the seller, it's still in the price. So it's $30,000 to get out and it's $30,000 to get in. So the old carpenter's adage of measuring twice and cutting once, I think, is particularly important for this type of decision. A home is a massive decision. And yes, oftentimes you can refinance, but I want to caution you that don't plan on being able to refinance. Again, interest rates are super hard to forecast. In 2006, I bought a home almost 20 years ago. And my mortgage rate was pretty close to what they are now. And I was fortunate I was able to refinance on the way down. But, we could be in the 5 to 6% mortgage rate for a lot longer than people think. So if you're in a home, think really carefully before you give up that low mortgage rate that you have. If you're assuming, mortgage rates are going to come back down. They might, and I hope they do. That was a wonderful thing to have mortgage rates that low for as long as they were. But don't count on that. Make a decision that you're still in a good situation, whether mortgage rates drop back down to, those historic lows, or whether they stay more towards historic norms, historic averages, which would probably be in the 5 to 7% range, would probably be closer to the historic average. So the goal is to make a good decision. And speaking of making a good decision, if you're in your 50s, this is go time, right? That if you've always wanted to retire early, now is the time to be thinking about that. And that's why I made this video up here called It's Go Time. If you're in your 50s, think about whether now's the time to retire. I'm not saying at 50 you retire, but start planning for that. So I'll see you in that video, and thanks for watching this one.